Well, hi. I hope everybody can hear what we're saying today. Marsha was helping me. I couldn't get my video on, so she's smarter than me. Uh, Welcome to this class today. We're seeing this slide presentation begin with the February 18th announcement. I'm going to delete that and then bring into view the slides. And as we know, this class is designed for the do-it-yourself investor, or if you have a family member helping you with your investments, or you hire an advisor. And if you don't have any of those, it's here to help you maybe make the decision of which level to get involved in. But I want everybody to be able to have like a flyover view of what is going on out there in the investment area and allow you to take care of yourself. So if you let a family member or an advisor handle this stuff, we want to give you some awareness of what he or she should be doing and what they shouldn't be doing. It is a very dangerous area to make some big mistakes. So let's be careful. We want to make sure that people aren't trying to sell us things we don't need. The financial industry should be more on the fee-based or hourly or contractual level where you pay for your advice and the help that you get. We're trying to transition out of the commission-based one-time sales arena. Hopefully, most of us are out of that by now. But this course will give you some awareness of what you'll be looking at. And again, whether you do it yourself or you have somebody else do it, I'd like you to learn what this process might be considered. This is my process. Other advisors might have a different way of doing things. So we're in class 2, I believe, and we would like to get a view. We talked a little bit in the last class about section 1 of our workbook, Active Retirement Investing. You can download this book or we'll send you one for free. It's the class workbook that we wrote for the class. So hopefully it relates to what we're doing. But a few years ago, people asked me, is there going to be another class or anything more advanced? So I put this workbook together for the class. You can fly over it and pick up some important information that will help you either do it yourself or work with somebody. But we have specific pages that you can look at. And Paul, I'm going to give you the page of where I'll start in the next class. So it'll give you a range of pages to look at, and that will help you. That was a very good suggestion. In this particular group of slides, and at the end of the class, the first hour, we'll go over to Morningstar and we'll look at their printouts and their detailed information. But number one, don't be intimidated by this stuff not making sense. This is like taking a foreign language. You want to go to France, you go to a French class, yeah, you get a few tidbits, but it's difficult to be able to go there and speak the language. And in the investing process is like that. And things are changing every day. It's hard to keep up with what's going on. I have to listen to podcasts every other day on the weekends, watch video or YouTube on the weekend to see what has changed about Social Security investments and all the underlying things that have something to do with the investment process. Section 1 we talked about last time. We don't have time. We're not going to go into, but you need to review your cash flow analysis. Where are you going to be in the future? And now with costs going up, what has to give? You'll need to look at your insurances, things that you don't need, but things that you do. You'll have to look at your taxes. Should you or should you not convert an IRA to a Roth? Does that offset and make Medicare go up more cost and things like that? Don't make a move until you've done some homework on those things. So section 1 of the book, you read on your own. It's the financial planning process. We won't be doing it in the class because I'd lose too many listeners. It's more fun to talk about investments, but what's the point of investing if you don't have a good financial plan or a good estate plan? Because of course you have a will, a durable power of attorney, and all kinds of other things to be concerned about. That's section 1. Right now we're working on section 2. We've evaluated, or I'll tell you a little bit about how to evaluate your old investments and determine whether or not you want to hold on to them. And then where's the future going for the public, most investors? So we'll take a look at the next slide and see what we have for you here. Past investment structures, allocations, and categories. In the past, many, many years ago, there were investments that were brought to your doorstep by a salesperson. No longer is that needed because you can get on your phone, obviously, and you can look at apps and iPods investment programs and do everything like that. So we don't need a salesperson coming to you. But do remember one thing. If a salesperson is approaching you, it's because the company can't get you to come to them. So we'll see a lot of insurance agents pursuing business out there because people don't always want to buy insurance or annuities. They come to you and they invite you to a steak dinner. They take you to lunch. They do all these wonderful things. Well, be very, very cautious, because if the product that these people are selling was so great, you would be knocking down their door. They wouldn't be coming to you. So let's just leave that in the past. But you may have old investments that had commissions involved to get in. No problem. You've already paid it. But is that investment still relevant to what you're doing? We do want to warn you not to make a quick move without looking at the tax ramifications, but you don't want to hold something just because it's taxable and see it drop in value and you lose more than what the taxes would have been. So the old investments in the old days, a lot of people would buy individual stocks and bonds in a brokerage account, but that's not most of us. We didn't have the time to go to Schwab or something and do that. Many of us would buy mutual funds directly from the mutual fund companies. And that was usually from a local investment broker or advisor that came to us or invited us to a dinner, and you had a nice steak, and they talked you into investing, possibly into investing limited partnerships and annuities and maybe some mutual funds. Well, that's in the past. If that's what it took to get us invested, that's fine, but it's not what it takes anymore. You don't have to go and pay the high dollar commissions, and please avoid the steak dinners. There's always a catch there. So what did we invest in the past? Generally, well, a lot of people bought rentals and things on your own. That's fine. But publicly traded investments, many people got by way of old mutual funds from the mutual fund companies. Some went to the steak dinners and bought a limited partnership. And unfortunately, many learned the hard way that that was a bad way to go, to give somebody else control of your money. I recommend that you have control of your money by being able to get in and out quickly within a day or two, and not being stuck with some real estate program that you can't be liquidated for months or years. And if you do, you lose a lot of money. Do the real estate on your own. I wouldn't buy partnerships of any kind. Specifically, I would recommend today the exchange traded mutual fund that is regulated by the Securities Exchange Commission. No guarantee that it will go up or down in value. No guarantee you won't lose your money, but they are regulated. So the old mutual funds that you bought directly from the mutual fund company, you may have called or written to one of the big names out there. You bought your shares from them after you sent the check, and at the end of the day, they cashed your check and they sold you shares of the fund. And if you wanted to sell out, at the end of the day, they bought those shares back. The big mutual fund companies are now transitioning to the exchange traded mutual fund, because then they don't have to deal with the buying and the selling. It's kind of like a real estate developer that builds a complex, and now they've got to sell the units, and then they have to buy them back if somebody wants to do that. They don't want to do that. Vanguard, Fidelity, Schwab, and all these big companies would rather create the exchange traded mutual fund, put it out and sell it to people in the market by way of people called market makers. But then it's in the hands of the public, and then we buy and sell from each other. There are entities like a market maker that might buy or sell the shares from us if things slow down. But generally, the exchange traded fund created by a large company is put out into the market to survive on its own. That reduces the work that the mutual fund company has to do. Their goal is to earn that management fee. That's how they're paid. They don't want to be in the buy and the sell transaction process. It's too much paperwork. So they're transitioning to exchange traded mutual funds. Now, what is that? It's a mutual fund, just like the old ones, but it's one that is put in a basket, or securities in a basket, creating the exchange traded mutual fund. And you go set up a brokerage account at Schwab or at Fidelity or at TD Ameritrade or at Vanguard or all these different places, Robinhood. You can get a brokerage account, and from there you can buy these mutual funds. But if you buy a mutual fund from the company, it takes a day before you can buy in, because they're going to get you in or out at the end of the day. The management fee might possibly be higher because they have more activities that they have to be involved in, and more paperwork and back office maneuvers. But that company might also have the same fund in the form of an exchange traded fund that might possibly have a lower expense ratio because they don't have to buy and sell from you. They just push it out into the market and let the public buy and sell the shares. Let the brokerage companies do the buy and the sell for you. And it's not free. They say they're free with no transaction costs, but there are internal fees and costs that you'll pay. But they put it out there and let it survive on its own. So the company that creates the exchange traded fund, their main goal is to keep enough shares in there and buy and sell and handle what the public wants. So I won't go into great detail, but the exchange traded mutual fund is the wave of the future, in my opinion. The old mutual funds are okay. If you hold one, I don't recommend you immediately sell it to buy an exchange traded fund because there may be substantial taxes involved. Hopefully there would be no early withdrawal penalties or anything else. But if taxes and penalties aren't involved, then sure, look at that same fund in its new version, possibly in an exchange traded fund if they've created that. Or if you don't like the fund, you can look at something else. Your retirement plans are easy to buy and sell because there's no taxes today. You'll pay taxes tomorrow. But on a non-retirement plan, definitely look at the tax event that could occur. But again, you don't go broke taking your profits. So don't let the tax tail wag the dog type thing. Okay, the old investments, the old mutual funds, let's say per se, had upfront commissions. Some of them had surrender commissions. When they said we don't have an upfront one, they had one in the back. And then some of them said we have no upfront or back end commission, but their management fee was like a 1% too high. So old funds had commissions, long-term surrender penalties, and high fees. That was like A shares, B shares, C shares. You don't need to learn about these, but if you have some advisor or broker trying to sell you an A or a B or a C share fund, that means that you're either going to pay the commissions up front in the end or along the way, but you're going to pay them. Now, it doesn't mean that they're horrible and terrible and rotten, but it limits your choice of funds. I would rather do no load funds where I have 25 or 30,000 funds out there that have super low cost with no cost to get in or out. Now, if I want the help of an advisor, they're not going to be free. You're going to pay them hourly, or you're going to pay them a contract on a yearly basis or a percentage of assets under management. We'll talk about that stuff later. So the new modern day investment is the index fund, the managed fund, and the exchange traded funds, or basically index and managed funds that come by way of exchange traded fund structure. You can buy and sell them throughout the day, just like a stock. You can get in and you can get out. And they actually provide possibly more liquidity if you were to buy something that wouldn't sell very well. Let's say you bought one junk bond. Well, that could be at risk of bankruptcy. But if you bought a junk bond exchange traded fund, you might have 500 of them in there. They might drop in value if the market turns against you, but you could probably sell your shares of that junk bond exchange traded fund more easily than finding a buyer for one junk bond that nobody wants. Does that make sense? So it's a safety in numbers as far as liquidity goes. Internal fund parameters, whether it's the old mutual fund issued by the mutual fund company, and remember the word no load. I'm surprised we have to say that anymore, but no load mutual funds. But you never know. There might be an advisor that gains your confidence and then doesn't really point out the fact that if you buy these mutual funds through them in their brokerage account, you may have upfront or at the end or ongoing high cost. And you want to be aware of those. How is the advisor being paid? If you're working with an advisor, they deserve to be paid, but you deserve to know how. Laws are being written now that make it very strict for disclosure, and they're creating more of a fiduciary standard even for brokers. That's good news. So investment fund parameters, whether it's a fund issued directly by the mutual fund company, say a Vanguard S&P 500 mutual fund, you'll buy and sell at the end of the day, or it's a Vanguard S&P 500 exchange traded fund, which you'll buy and sell throughout the day. That could be good or bad. Let's say you bought at the wrong time, it was bad. But at least you're given that freedom. And then there are trading methods that, as you know, some of you advanced people, you can put in a market limit order or something like that. But the fund itself, whether it's an old mutual fund or an exchange traded mutual fund, We do like the idea of internal diversification. If you want to take a lot of risk, go buy one stock and risk it. Better yet, borrow on your house and risk it all. I'm not saying that. I'm being facetious, but that's how you increase your return, is to leverage up and take a lot of risk, which I don't recommend, or leverage down and take less risk by diversifying. Now, if I do my job right by diversifying, I'm never going to beat the market on the way up, because I've got a variety of stocks in an index versus one stock. And if that one stock goes up, we have several other positions. Our goal, however, when we're doing retirement investing, is not to lose all our money. So we don't prefer to buy one stock. We'd rather buy a basket of one or more exchange traded mutual funds. Exchange traded only because we want to be able to get in and out. And there are other tax efficient benefits to that. But for the most part, it's not going to hurt you to buy a mutual fund from Vanguard and put it in your brokerage account. It's just that it's not as quickly available. And there might be some other tax benefits that we'll talk about later. Internal diversification, because it's one thing to be down 65% March of 2009 in the S&P 500. That's scary enough. But if you had one stock that failed and filed bankruptcy and never came back, Lehman Brothers or whoever went out of business, that's worse, right? Because the S&P did recover. It took about 5 years, but at least we came back because you had 500 positions. Down 65, not a lot of fun, but maybe we added more and we kept adding a little bit each month or each year in having faith that the US economy would come back. But if you buy one stock that goes under and fails and never comes back, you're done. So internal diversification by mutual funds or exchange traded mutual funds, in my opinion. There are other things you can do, closed-end funds and limited partnerships and trusts and all that. But for most of us, we want to wake up, get on the computer, see what your investments are worth. Know that if you want to get out, there's probably buyers. The S&P 500, you'd get out in an instant. There's always buyers and sellers. But if you get something very unusual that doesn't have a lot of trading activity, you're kind of stuck, but at least you can look around for a buyer. Dividend reinvestment. A lot of the exchange traded funds and mutual funds should allow you to reinvest your dividends. That's good while the market's going down. You can pat yourself on the back that at least I'm reinvesting. If you don't have the courage to buy on the way down, at least the fund is reinvesting. A lot of people say, I'm buying dividend stocks, they're better than non-dividend stocks. No, it's just an immediate payoff versus a future payoff, right? A high dividend Procter & Gamble or some other stock, AT&T, that pays a large dividend is an immediate payoff versus buying Amazon that could be a really big payoff someday, but they're not paying you the cash flow right now. Many of us retirees are looking at dividend stocks for a couple reasons. One, if the market crashes, but I'm earning 3%, let's say, of all the stocks together, I can just wait it out and draw the dividends and not sell something that's down. Or if the market's down and I don't need them, I can be reinvesting the dividends and getting cheaper prices at that point. But if I got money that I can wait 10 years, obviously the dividend stocks are no longer what you're looking for. You're looking for growth stocks, and that would be technology and various other ones. And why do tech stocks drop when interest rates go up? Well, if we're going to wait 5 or 10 years for the dividends on the tech stocks, maybe some people get discouraged and just run over and buy CDs and hoping that CDs will be up to 3.5 or 4. Don't know where they'll be, but they're thinking, why should I take all this risk of tech stocks? I'll just go buy CDs. Therefore, tech stocks drop in value. But in the long term, you and I know there's a future in tech, obviously. And so it's a good idea not to get totally out of that. So dividend reinvestment, great. It's wonderful, but there's strings attached. Access to market sectors and that were historically not available. There are new exchange traded mutual funds coming out every day. They don't have them out for this Bitcoin and digital currency yet. The SEC hasn't approved it, but when they do come out, then that will give you the ability to be in a diversified portfolio rather than trying to pick which of these little digital currencies are going to take off. I'm not saying it's the way to invest, but I'd rather be in a fund, and preferably a managed Bitcoin fund where other people that know what they're doing can be investing my money. Generally, I don't want managers because they cost more. I usually prefer to build a base of a pyramid into index funds that follow indices like this. There are companies out there. Dow Jones Industrial Average was that index was created, I believe, by Mr. Jones and Mr. Dow or something years ago, and they followed the railroad stocks and things. But there's a Dow Jones Industrial Index of 30 stocks that a company watches those stocks. They do the math, and if one grows bigger than another, then they change the percentages of how they're represented in the index. So all of the companies that have a Dow Jones Industrial Index fund have to track and pay a subscription to the Dow Jones Industrial publisher. The S&P 500, all the companies that follow the S&P 500 have to pay a company a fee to match their funds to that publication of what the S&P is doing. And guess what? When the S&P publisher recalculates the number and says, look, Sears is going bankrupt and we're going to replace them with Walgreens, well, then you're going to have Walgreens in place of Sears. Now, it's not a big impact, but when we know that they're going to be getting rid of Sears and getting Walgreens and all these S&P 500 funds, Vanguard, Fidelity, Schwab, iShares, tons of companies, that's a lot of Sears shares that are going to be sold. Guess what happens to the price? And that's a lot of Walgreens stocks that are going to be bought. This happened 2 or 3 years ago. So index funds are great. If everybody did index funds and nobody bought and sold stuff, the market would crash big time. So we do need buying and selling to give us some pricing structure to let us know what the stocks in your fund is worth, thus what the shares of the fund is worth. So Dow Jones, S&P 500, and the biggest stock in S&P is, I think, Apple, and it makes up about 6 or 7% of all of the index. And this is why we need somebody calculating this stuff regularly. Total market index is all the stocks that are available in the stock market. There's actually less than there were 10 years ago because companies are buying back their own stock. But I'm going to guess there's probably about 2,000 plus stocks in the total market index versus 500 in the S&P 500. And if you look at the S&P 500, the top, I don't know, 25% is made up of tech stocks. If you like that, the S&P is wonderful. If you don't like that allocation, maybe the total market index fund is better for you because it doesn't weight everything to Apple. Now, there are other ETFs in the S&P that change the weightings. We can talk about those later, but this gives you an idea of what the broad indexes are. There are managed funds that will actually track an index. Well, why would we have a managed fund do that instead of an index fund, which would be super low management expense? Well, there are some managed funds right now tracking the S&P 500, but they'll only put 80% in the S&P 500 and 20% they might buy other stocks to hedge the downside. They might buy options, puts and calls and things. So I noticed one of these funds that does this was down significantly less than the S&P was when it was down. So there are S&P 500 index funds, but they're managed because they do a little tweaking. And if you don't agree with that tweaking long-term, obviously we're not looking at buying those. An index fund that has one of everything is usually historically proven to outperform the managed funds in the long term. But my theory is if you're going to be investing within a 10-year window, there may be a managed fund that might be better than an index fund if, in fact, it's a risky area. Junk bonds, I'd rather have a manager on top of the credit rating and the maturities. Someday when they come out with digital currency, I think I'd rather have a managed fund for a while and let somebody protect me. But generally speaking, 10 years or more, in my opinion, index funds will always do better than managed funds because they buy and hold and they don't have the costs of buying and selling or the risk of making a bad decision. So index funds track the popular indexes. We looked at a few. There's a bond aggregate index that you can look at to get a total bond market index fund. The only problem is the maturity of the bonds are too long for me because they're probably down 7% already. And as you've been hearing me preach for the last few years, we want to avoid long-term bonds. And there are long-term bonds in the bond index because it's an average of short-term, intermediate, long-term. And the reason I've been preaching that is what if interest rates go up? Well, now they're doing that. And now you have bond funds that have 30-year bonds in it dropping 7% or more in just the last couple months. I would rather use the money market CDs, ultra short-term bonds, and short-term bonds, which aren't going to earn much. But when interest rates go up, they don't tend to drop because they can renew their maturities. Now, when interest rates hit a peak and we're all complaining they're way too high, well, okay, then it's time maybe to look at longer-term bonds. Dow, we talked about S&P, total market, and then self-indexing. What is self-indexing? Well, if you don't want to buy 30 stocks in the Dow, 500 in the S&P, 2,000 in the overall stock market index, you think you can do it better, and I think we could have fun with it anyway. Let's say we create a baby boomer index fund, and when we're looking at down here at self-indexing, all that means is we set up a brokerage account where they don't charge us to buy and sell stocks. And we get together in monthly meetings and we calculate the top 50 stocks from companies that sell products and services we believe the baby boomers will use over the next 10 or 20 years until we phase out and there's nobody left again. If we did that, we would call it the baby boomer index, and we might have stocks on the best cruise ship companies that we believe in, but the best medical care facilities that we think will be there for us, the best housing projects that we think baby boomers might move to, but all the things that baby boomers might be buying now and throughout the rest of their lives, which could be 10, 20, 30 years, let's say. That would be our own baby boomer index. We could set up a fund right now and invest in that fund. Or if we wanted to go public, we would publish our rules of this index and then make Vanguard and Fidelity and Schwab, if they all got on board and said, oh my gosh, why didn't we think of this? They would pay us $2,000, $3,000, $4,000, $5,000 a month to track our published patented index. So that's what happens with the S&P 500. Vanguard, Schwab, Fidelity don't own the S&P 500. They just publish the records and the information of how to allocate from the companies that create it. Exchange traded funds we've talked about. Here's some brief information, and let me go back a slide or two. On page 80, we've mentioned this a little bit. You can look in the book now or later and kind of follow along or read a little bit more information. Because again, if you're new to this, don't beat yourself up. It's a lot of information. I have to sit at Starbucks on the weekend watching YouTube videos on a new concept that I'm thinking, what the heck? It's like telling me how to fix my own car. You might be able to do it, but it's going to take a long time to get your head wrapped around what they're talking about. So if this isn't for you, stick around just to pick up some tidbits so you know that when an advisor or a broker is trying to sell you something or do something inappropriate, you can pick up on it. We want to make sure that we're protected. If you're into doing it, then obviously I hope that this helps you do the trading and the aspects that you're looking for. But if you work with an advisor, in my opinion, that person should be fee-based, hourly, or contractually paid. You want them to be paid to do a good job, or they don't have an interest in helping you. But you can do this yourself if you're obsessed with it like I am and you love learning about it. It's something to do. We're not going to sit at home without a hobby. But if it isn't what you want to do and you want to travel, let's make sure you know what should be done for your benefit. Exchange traded funds. So if you're investing and you've done the financial planning process and you've got an old 401k that you transferred to an IRA, obviously we know at 72, you have to start drawing what will probably be about 4% a year. Okay, that's fine. But what kind of portfolio? You could have two of these. You could have more portfolios, but let's say we're creating one for this IRA. When we put exchange traded mutual funds in it, and there might be a few regular mutual funds that aren't converted to the exchange traded fund yet, and so you have it in the portfolio. I have some of those out there. They're managed funds. Their management fee is ridiculously high, but I have one that manages the risk of preferred stocks that every time the market crashes in preferreds, they tend not to be down as much because they have to buy derivatives to try to reduce it. Okay. It's an ungodly expense on the fund, but they've really earned it over the years. So I'm willing to pay 0.80 for my clients to own it, but I wouldn't encourage you to pay that kind of expense ratio. The client's portfolio expense average should be down to 0.25% or less. I would like that. So exchange traded funds, there's 5 structures in here. You can read them. This isn't going to help you, but it's just there as trivia. Buy your own exchange traded funds directly through your brokerage firm, as we've mentioned, through Fidelity, TD, Schwab, and all the others. With ETFs, you're buying and selling shares from another investor or a market maker called an authorized participant. So they give you more liquidity, you can get in and out, and you can slap on some protections like a limit order and some of these other things that if you wanted to do that, then I would say, let's have you go to watch some YouTube videos on how to do the trades. I don't want to take that responsibility of teaching you, because if we do the wrong thing, it could spell disaster. And one of the things about these putting orders on trades, I remember several years ago, there's an exchange traded mutual fund that's called an asset allocation fund that had about a third in cash, a third in bonds, a third in stocks. I'm sure it's not exactly that, but it was a very conservative exchange traded fund. And the advisor, this little story has it, put let's say a 10% stop loss, that if it starts to fall as far as 10%, sell us out. That means it might be a horrible market. Well, the market fell 50%. This is when we had that flash crash. I'm not sure we ever figured out what happened, but temporarily this conservative exchange traded fund was down 50%. And so the computer sold it at a 50% loss because there weren't enough buyers to sell it at 10%. He had an order to say, if it hits to 10, start selling. Well, it started selling, but there weren't enough people to buy it. And he didn't have a limit order to stop selling if nobody buys it. So it dropped 50%. Then the darn thing rebounded and it was only down 2% for the day. So if you get into entering orders, watch a bunch of videos from legitimate licensed advisors and find out how to do it. It's not something to take lightly. And if you don't want to bother, then yes, buy the fund from the company at the end of the day and don't take your chances. Because an exchange traded fund could be way up and way down, and by the end of the day at a completely different price. And you might have wished you bought it at the end of the day, or maybe you wished you bought it at the beginning. We don't know. And here's a little trivia. I'm told from the lectures I've listened to, it's better not to buy in the first hour of the market opening. So for us, that would be at 6:30 to 7:30 in the morning. And it's better not to sell, or I guess sell at the last hour, because maybe people get a little carried away. There's no facts to endorse that, but it's something to think about. ETFs, management expenses, these are the things that we believe are much lower than mutual funds. Well, not necessarily true. In general, on the mass group, I could say that could be true, but you got to be careful, because there are some funds out there that I've seen as high as 1.4, and now I'm seeing them for 2.5% expense ratio. I cannot believe that they're muddying the waters of the exchange traded mutual fund market. That disappoints me. But the companies are just moving on in, and it's kind of like, there goes the neighborhood, right? But generally speaking, if you're using total market index funds or regular index funds, your expense ratio should be below 0.10, in my opinion. If you're going to the next part of this pyramid, a smaller group of specialized indexes or passively reallocated index funds, probably 0.2, or let's say 0.15 to 0.20. That's fair. And then if you get up to a managed fund, it could be anything, as long as they're giving you substantial benefits in return, because I don't want to pay over 0.15 or 0.25 unless they're doing something I can't do myself. If they rebalance and they do things and they protect me, sure. That managed preferred stock fund, my clients are earning 5.5%. Well, I've seen them have the best downside performance, which brings up another thing. If you're managing a nest egg, and I do that for my clients, most of the clients don't want to bother. I mean, if they're demanding huge returns, they would push me aside and do their own thing. They just want to invest and try to keep pace with inflation, do a little better, and try to reduce the downside. So if I do my job right, I'm always going to underperform any single index, the Dow, the index, or the overall market, because I might have 40, 50, 60% in fixed assets, such as bond funds, which is quite difficult today because I'm not encouraging people to buy intermediate or long-term bond funds. They might drop in value if interest rates keep going up. So we have to hold money back, and it's very complex, and it's hard to find a good yield for clients. So the expense ratio for the fund is relative to what it does and what it doesn't do. And then obviously, if you have an advisor, you're paying him or her. And if not, you can buy newsletters on how to allocate your portfolios. So if you're standing back there saying, Bill, I'm not going to hire somebody, absolutely. Do your financial planning, do your estate planning, and find a good, legitimate newsletter that tells you how to allocate, what to do. I've seen people do just fine. Now, they oversell themselves saying that they can guess the market. Nobody can. There's over 100 million investors today and tomorrow that will trade. If you can tell me how 100 million people and algorithms and computers will react, good for you. You'll be the best psychologist in the world. But we can't predict, because an event could happen tomorrow. I've seen interest rates actually go up and bond fund values hold. What? That's the reverse of the calculation. Well, that was because it showed that the government was getting control of inflation and the economy might be more stable, and the companies issuing the triple Bs, the single B, the single A bonds are going to survive. So then there was no reason for the bonds to fall. But generally speaking, you'll learn something called duration. If interest rates go up, the bonds should drop relative to their maturity rate. Don't want to bore you with the details, but it's in the book. The managed funds, where am I? Exchange rate, yeah, you can get exchange traded index funds for as low as 0.02, 0.05, maybe 0.10. The average high is around 0.35, and they can go as high as 1.4. Like I mentioned, ETFs are a wave of the future. So there's always new ones coming out. And I give you a list of things to do, or your advisor to do, on a daily, weekly, monthly, quarterly, biannual, and annual. And one of the things is, on a monthly basis, is to go shopping for new ETFs, because there may be a new one. Let's say Vanguard had an ETF, and Fidelity or Schwab's trying to knock them off the block, so they come up with the same thing at a lower cost. Well, if it's in an IRA and it doesn't cost you, then you could sell the Vanguard and buy the Fidelity, or sell the Fidelity and buy the Vanguard. So one of the things on your list is to keep shopping exchange traded funds. I do that for my clients to see if I can drop the expense of the fund if they're doing the same thing the old fund did. That adds value. I'm like the guy washing your window at the intersection trying to prove value. Okay, I did something good, pay me. There's a million things that advisors have to do behind the scenes. They're not glamorous like a lot of administrative work, but if you want to do that yourself, you absolutely can. ETF questions, elements, and things to consider. Page 83. So far, how am I doing? I usually get in trouble for talking too fast. Is there any questions? So I'm going to take that to speed up my talk. I'll try to go slow. On page 83, you can look at this stuff. Exchange traded funds, questions, and elements to consider. Remember, an exchange traded fund is a basket of stocks and or bonds, or a mixture of them. There's tons of them out there, and there's all kinds of companies. If we came up with that baby boomer index and we published it, and then we said, great, we're getting money from Fidelity, Vanguard, and all these companies to publish it, but let's do our own fund, because if we can raise 100 million and we charge 0.25, we can earn 250,000. Well, the bad news is it costs, I'm told, over 300,000 just to keep the darn thing going. So we need this thing to grow to 200 million or plus. But we might do that. And the reason we would create this fund is so we can get part of that management fee. Let's say above 100 million in assets, or over 100,000 in expenses, or 250,000, we can then start making money. If you buy an exchange traded fund, these are some of the issues to look at, and you can find this on hopefully page 83. What's the age of the exchange traded fund? Has it been out there? Has it been around for a while? It's kind of like somebody that charges you to cater parties. How many parties have you done? Do you know what you're doing? The next one is, how large is the exchange traded fund? The massively large index funds are great, because the more money they have, they can reduce their expense ratio. It's proposition of scale. They get really big, they can reduce the cost. And if it's total market index fund, like I said, there's one that's 0.02. You'll have to find it every month when you go shopping. But size isn't always good. If you want it to be a nimble managed exchange traded fund where they could get in and get out and do this, then we don't want a big company. They're going to charge you a higher management fee, but they're going to be able to get in and out of areas where a gigantic fund that has a low expense ratio could not. So we want to know how large is the fund and then decide, is that a good thing or not? Exchange traded issuing companies, even if I buy an S&P 500 exchange traded fund, I would rather have one from Vanguard, one from Fidelity, one from Schwab, one from iShares, and there's others that do that. Why is that? Well, if I have a brokerage account at Schwab, all they're doing is keeping the information online of where I have bought all these funds. But if there's a breakdown, let's say at Vanguard, because COVID breaks out and it's really bad, nobody can even go to their desk and get to their computer, or for reasons I can't think of, I don't want all my money with just one big company. They're all super great companies, really low cost. If I have an exchange traded fund, I might have 3 or 4 different ones because I don't want to be all with one company. Or an S&P 500 at Vanguard and a total market at Schwab and something else with all these others. But we do want to consider the company that's issuing them, because I know some issuing companies are more adept to creating small, unusual ETFs and trying to start a new trend, and maybe they'll get a ride for a while. The big companies tend not to do that. They'll wait until there's a lot of popularity, and then when they put their notice out, they'll raise 100 million overnight. It's not a problem, but their expense ratios will be less. It's kind of like the old cowboy movie where the first cowboy that breaks through the door takes the bullet, right? The big companies usually don't come up with extremely innovative funds right away. They'll wait to see what happens in the market. They're smart. They don't want to waste their money. Total expense ratio, TER, if that's important, on page 83. Obviously, these are all no load funds. Exchange traded funds would never charge you a commission to get in or out. The brokerage company may or may not charge you $5. Most of them do not. But then again, if they do charge you $5, they might get you in a better trading cycle and get you a better price. I'm just saying, that's what I've heard. So just because the trading is free doesn't mean that you get put at the front of the line. Maybe somebody else that pays a small ticket charge might get a little preference. The SEC regulates this, but there is a kind of a bandwidth of what they have to do, or they have to do for you. And they might, if you're paying them a transaction fee, you might get a little bit better service. I'm just saying. Remember, Robinhood was taking in trades and it's free, but actually they were letting somebody else do the buy and the sell. And when you do a buy and the sell, there could be a bigger spread between what you get and what they sell it for. So you got to be careful. It's kind of like if you were going to sell your house, if the broker could expand the commission to 10%, you had to pay it. That wouldn't be so good, but they can go up to 6%, I hear. Okay, so the next one is trading volume. Again, if it's the S&P 500, I wouldn't worry. I could probably sell that at any time during the day. Its value will fluctuate, but I'm not worried that I get a log jam of too many people wanting to buy it or not enough wanting to buy it. I know that that's a smooth buy and sell for the most part. So the volume's good because you could buy a small cap growth fund, the market tanks, and all of a sudden there's no buyers. Well, what happens to the spread? If it was $10 to buy the share and no buyers are buying, and one of these so-called market makers have to buy it, or authorized participant, they might only offer me $9, and they're going to try to sell it at 10 because there's no market. They don't want to be stuck holding this inventory of small cap growth fund if the market's crashing. So the spread increases. If it was the S&P 500, if it was worth 10, I might get $9.99. Somebody's got to make a penny. Okay. But what if it's a small cap growth fund? The market's on its way down. People are getting scared. They sell for 10, but no individual buyers want to buy it. So the market maker steps in because I think they're required to buy stuff, but they're dropping it all the way down to 9. And the SEC says, that's fair. There's no buyers out there. So I end up losing 10% on the sell. So if I buy an exchange traded mutual fund or a stock that has very low volume of buying and selling, I run the risk of the spread increasing massively. So you want to be aware of that. If it's something you're going to buy, let's say it's a new Bitcoin ETF, and I'm going to hold this forever, and I don't care what the volume and the spread is, go for it. And if you're not going to sell it for a few years, you'll find a time where you're comfortable, and the bid price is what you get is comfortable for you. That's the spread between the bid and the ask we just mentioned. If you want to sell something, you put it up for the ask price and somebody offers you a bid price. It's lower than the ask. My heart always beats because did I get that in reverse? I'm pretty sure you sell it at the bid and somebody buys it at the ask. If there's no buyers out there, I'm going to get a really low bid. If there's tons of buyers, I'm going to get a bid price that's very close to the ask price, maybe a penny less. So the people buying and selling can make something. So remember, you're not being charged a ticket charge, $5, $7, but there is a spread and somebody's making it. What is the index or sector of your fund? So obviously, when you look for an exchange traded fund, not every fund that people buy is an index fund. If you're a long-term investor and you don't want to bother with it, sure, you could get small cap, mid cap, large cap, international index funds. Put yourself in a time capsule, wake up in 50 years, and you'll be just fine. But maybe along the way, some people believe that there needed to be a little bit of management. Okay, that's fine. But an index fund long-term, statistics show 10 years or more, in my opinion, are going to be better. But what happens within 10 years? If I'm going to buy a junk bond fund index, I want a manager in a managed fund rather to keep an eye on those companies. If one of them runs into some problems, maybe my manager is going to get me out sooner than the index publishers. So something to think about. Securities in the fund held, obviously look and see what they are. Do you recognize them? If you do, they're probably higher priced because they're already grown quite a bit. If you don't recognize them, that could be good also if it's the type of fund that you want. You don't want a growth fund with a high management fee with all these top technology funds that are already in the index. What's the point? We want to know what's in the fund. Obviously, a utility fund would have nothing but utilities and so on. Allocations of the fund. Do you agree with what percentage it has in certain areas? The S&P 500 is allocated based on the publisher that publishes the S&P 500. But if you buy a specialty fund, do you agree with what percentage they have where? Geographically, or the size of the company, or growth versus value type thing. Very quickly, in my brief opinion, a value company is kind of like you buying an apartment building that all the units are rented up and there's cash flow, and you're really buying cash flow from the rental building. It's probably not going to go up a lot more in value because you've already maxed out its income. Now, maybe real estate prices go up, but the value of an apartment building is representative of what it earns, not how beautiful it is. A growth stock is more like buying raw land or in a housing area where they're starting to build houses. There's a lot of upside potential there. Now, there might be downside if nothing happens, we run into a recession and the raw land that you bought or all those housing plots that you bought crash on you, and you're going to wait 5 or 10 years for them to come back up. But value means it's valuable to me today and I'm getting income, and growth means I'm going to be willing to wait 5 or 10 years. Now, in the interim, it might go up in price per share and you can always sell it in 2 weeks. But generally, that's why you'll see tech stocks and Amazon and them fall if we think interest rates are going to spike quite a bit, because people maybe don't want to wait that long. But who knows? I've watched this market for 42 years. Some of you have watched it longer. We could predict one thing today and the opposite happens tomorrow. That's why financial planning comes into this and allocating a portfolio correctly. Like I said, if I do my job right, I'll never beat the index because we're more diversified than one index. On the way down, however, many of the nest egg investors, even though in 10 years, you might only have 4 or 5 times to say, I beat the market on the way down. It dropped 20% and I'm only down 10, ha ha. Well, in 10 years, that doesn't mean anything. But in the short term, it means a lot to know that if the market dropped 20 and you're only down 10, that you could start liquidating some of your bonds or parts of your portfolio and survive your retirement. So if I do a balanced portfolio, I'm not doing you any favors long-term for growth, but we are setting up for the short-term crash in the market and the possibility that you need money. Now, right now, bonds aren't necessarily the greatest place to invest. So maybe you're going to park more money in cash or ultra short term and assume that you're not earning anything. The flip side of that problem is, what if inflation goes up to 7%? My CDs, my cash is not earning anything and losing 7%. That's a dilemma. We're in a real pickle right now because if interest rates were at 7 and inflation were at 7, you would break even. But you're losing 7% with the market or the inflation going up and costs going up. You're losing 7% on your cash. But do you seriously want to risk your money in the market in the short term? I don't know. The market could crash 20%. This is the problem of allocating the portfolio. Every person's allocations, risk tolerance, liquidity needs, and preferences are completely different. Please, not every investor should have the same portfolio. If you go to some of these big companies I mentioned, they'll charge you over 1% to manage the portfolio, but they'll put you in a portfolio A, B, or C that they predetermined. And so you're on an assembly line that may not specifically meet your preferences. Yes, they'll ask questions of risk or liquidity needs, but they're not going to worry about whether you agree with why they bought something, and they're not going to check in with you. It's this portfolio or nothing, in my opinion. Strategies of the funds, yield of the fund, that's important. Tracking error, we're getting close to coming out of these slides and we'll move on. And I'll go fairly quickly now. Is the fund leveraged? Does it borrow? Meaning, does it go to the bank and borrow money for you, which could be risky? Questions and other elements, fixed income, bonds. We are worried about the maturity and liquidity. We like bond ETFs rather than individual bonds because they could get sold easily. ETF closures and capital gains. If your ETF's too small and not raising enough money, they could close. Now, you're not going to lose your money. They'll sell all the positions and send you the cash. But if there were any gains, you might pay capital gains. So if you don't want that risk, make sure you stay with, I'm told, $100 million or more in the portfolio of the ETF, or run the risk that it doesn't take off and you get your cash back. So those are things to consider. Market limit, stop loss. I'll leave that up to you to learn. We might have time to do it, but please don't just enter orders willy-nilly. Make sure you know what you're doing. Page 86. Taxes we'll talk about later. They are more tax efficient for the most part. All these other things can create income from selling options. Some of the old, if you put your money in one of the big brokerage houses, they own a bunch of Apple, they can rent your Apple shares back and they can keep the revenue from that. In your ETFs, they'll rent your Apple stock and earn money, but they'll give it back to the fund itself and by way of reducing the expense ratio. So those are things to recap. Consider the market, liquidity, average spreads, average trading volume, and premiums and discounts. A lot of stuff. I'm going to bring over another slide if this works properly. Hopefully you can see this. This is Morningstar. So we're almost at the end of the 11 o'clock hour. It's 10:55. We covered a lot of information that could be so boring you don't even want to hear it. But if we aren't aware of these, somebody's going to pull a fast one on you possibly, or maybe you make a mistake on something. We all know, because I do it frequently, I don't want to read the instructions, and it takes me forever to do something where had I read the instructions, I might have gotten it done. Today, with everything being on the computer and digital and very dangerous, the frustrating thing I have, you might have, that I have to sit down and actually know how to do something, actually know how to go to the IRS website, actually know how to put in my bank account, actually send them money without messing it up. I have to focus. And in the old days, people got older, things were simple. We didn't have to focus on everything. So take your time and at least flip through the book. And in the beginning and in the end, it will tell you what somebody should be doing for you. And there's actually a website that if you ever decide you don't want to do it, please do a background check of any advisor you're going to work with, and the book will tell you where to find that. So we've talked about the primary investment vehicle I would recommend would be a brokerage account. that is insured from fraud and cybersecurity. As long as you don't do anything wrong, the company itself, we're hoping they don't get hacked and lose anything for us. They carry a lot of insurance on it. But the brokerage account allows us to be massively diversified by consolidating into the brokerage account, but have our investments with different companies like the Schwab, Vanguard, Fidelity, and so on. So we have a brokerage account. If it's an IRA, we call that a qualified account, meaning it qualifies to be tax deferred, and not until you pull money out will you pay taxes. A non-qualified brokerage account would be just regular stocks or exchange traded funds, mutual funds, and whatnot. And when you buy and sell something there, you have to consider it was a buy and a sell. So what's the tax consequences? So looking at the retirement qualified plan, the rollover IRA and so on, you can move money around internally, but it's not until the money comes out. But outside of that, be careful. So if I ever say, get rid of a high cost fund, well, look at the tax ramifications first. But then again, we don't want to not sell something if it's horrible and terrible just because we'll pay taxes. But do see your tax person or run a tax assessment and see if that's worth it. Any questions so far? Okay. I'm going to refer to this page, which is very small print, but it is the Morningstar page that I get. This is called Advisor Workstation, and I have to pay a fee of a couple $100 a month or more to have access to this. And it immediately, the first thing that I see is all these green little blocks. I always like to joke around. I made the market go up today because we're talking about gains. This you can't see. This little block says 1 week, 1 month, 3 months, and so on. So I can get a visual of where we are and where we've been. And all these little blocks represent small, medium, large companies, value meaning blue chips versus growth, meaning companies that might not pay a dividend for quite a while. So I can see in all the areas or sectors, if you will, how the market's doing. I can come down here, and if this is too small, it says 410.6 is what the market's up today. S&P, NASDAQ, Morningstar indexes. So that'll give you a little bit of heads up on what we see. In what we did last time is we looked at an individual fund, let's say. A lot of people say, I'm just going to buy VOO, V-O-O, that's Vanguard S&P 500 ETF. There's also SPY. I think Vanguard might be slightly lower cost, but when you get down below 0.15, cost really, I'm not going to worry about it too much. This one here says that the expense ratio is 0.03. So this is the Vanguard S&P 500, but they follow the publication that they pay for to create this fund, and every other S&P 500 fund that is a pure S&P 500 fund has to do the same allocation. And when they all get the notice to sell Sears and buy the other one, then they have to do it. And so your S&P 500 fund at Vanguard is not any different than Fidelity or Schwab, but I'd rather not have all my money at one of those companies for reasons I can't think of, but I just don't feel comfortable leaving all my eggs in one basket. But if this is the lowest S&P 500 fund, maybe I'd buy it lowest in cost. Okay. If this program cooperates with me, this little chart shows us in red because the red represents the index, the S&P 500, and the blue represents our fund. And then the yellow represents the category of other funds that use the S&P, but might do things a little bit differently. But you'll notice that we're mirrored into the red because we are exactly the same, minus 0.03 expense ratio. So you might not be able to see it, but it's possible that we would perform the same in the up and down side minus our expense ratio, and it's almost nothing here. So we expect to do almost the same. How is this index done? Well, year to date, if you can see this, it's down 7.55. That's not the fund's fault. It's not Vanguard, Schwab, Fidelity, iShares' fault. It's just that's what the index is doing. Year to date, meaning a month and 2 weeks. So now we're not doing so good. Is it a time to buy in? I'll leave that up to you. Is it a buying opportunity? Possibly. But I hear that corrections go anywhere from 10 to 20% on a downside. And I think a 30% decline is like a correction on a bear market. So is it down enough for you to buy right now? I don't know. If you think we're going to be pretty strong going forward, it might be. But if you think the market's going to correct and we're going to see a 30% decline, then maybe it's time to wait. I don't know. I've been trying to outguess 100 million traders for the last 42 years, and it doesn't work. You just do what's right for you and your allocation and your belief. If this is a fund for the grandkids, buy some, not a problem. And if it drops further, buy some more. They got plenty of time. But if I'm 75, 80 years old and I'm living off my portfolio, I don't think I would gamble it. I probably would go to an equally weighted S&P 500 fund or an S&P 500 fund that looks for the highest dividend stocks, simply because I need my dividends now in case the market crashes. I might have to live off them. So everything's relative to what you want to do. It's your situation calls the shots, not some smart alecky advisor that says they think they know what the future is going to be. Give me a break. We don't know what that will be. Average standard deviation, we'll read about that later. For this investment, it's been 17.54. Now remember, sometimes I'll have a client say, well, Bill, my portfolio is only up 8%, and the portfolio and this fund's up 17. Well, this 17.54 is the average volatile history. It's like a roller coaster. It's never the same. It's a rolling average. I can't say that every year it's up 7% and then down 17% and then it's down 17. That's just the rolling average. But do know that on a rolling average, if you're in the S&P 500, we just saw it was down 7.5%. Its average is 17%. And we haven't seen that in years. So be prepared that if you make this commitment, be prepared to hold and or buy and buy into the declining market. Don't just get mad and walk away and leave it. Now, the downside risk of this fund is 100% of its index, because it's the index. So it's not going to be 90% as risky or 80 or 50. It's going to be 100% because there's no question why. It's the same. Remember in the last class, you could ask your friends how many stocks are in the S&P 500 and they say 500. And there's actually 507 or so. Some of them have a different category. I think it was Google has a couple shares like A and B shares and so on, Metaverse and all that. And Google is Alphabet. So in this S&P 500 fund, Apple makes up 6.83, but the next time the S&P 500 publishers recalculate it, and if Apple grew or shrunk in its size, then they'll make the allocation changes, and then everybody will have to they'll have to sell off something and increase the shares of Apple, or if Apple takes up a smaller percentage of this index, they'll have to sell some Apple and buy another stock in the index if it grew. So that's the only trading that they should have. Very little buying and selling, just keeping up with the allocations of the index. Does anybody know how often they recalculate the index allocations? I don't either. It's probably every couple of years, I guess. I can't imagine they do it every month. This is something new. Don't worry about it. I looked at it. What the heck is this? This little thing is like vibrations, attention. S&P 500 got a lot of attention and it appeals to a lot of people. Some of you might say, okay, I'm getting out. It's time to leave now that everybody likes it. So that's the S&P 500 fund. And then I'm going to look at a portfolio soon, but I'd like to bring up another fund in this category. I'm going to look at my research list that I have available. And these are a research list funds that I change it on a regular basis, but there's a lot of them in there. I'm not encouraging you buy any of these, but you'll see ARK, which is a high cost technology fund that crashed 25–50%. Some people like it, some don't. You may or may not like that. I'm going to look for, here's a Fidelity Balance Fund, just to see what a balance fund looks like. This is Fidelity Advisor Balance Fund. It's not an exchange traded fund. I don't see that they have one yet. It's a mutual fund that you would buy from them through your brokerage account. However, if you have your brokerage account at Fidelity, then they won't charge you a transaction fee, or maybe if you're somewhere else. And that's a good point. If you own a mutual fund and you go to Fidelity, Schwab, Vanguard, or somebody, and they say, yes, you can buy that mutual fund for no fee, but it's not our in-house fund. How are they paid if they're not charging you a transaction fee? Because remember, your brokerage company makes it on the spread, right? They buy it from you at the bid and sell it at the ask, and they make a penny or more. But if it's a mutual fund, they don't sell it like a stock. So how do they make any money? I want to go buy Fidelity's mutual fund, but I want to buy it at my Schwab account. I can buy it, but how does Schwab get paid? They're not getting the spread because it's not an exchange traded fund. Well, what's up here? Oh, they must like each other. No. Part of this expense ratio 0.45, which is kind of high. I think there's another one I know of, a 0.07, but they would argue they do a better job managing it. So let's say you like this fund. 5 stars out of 5. So it's in the top category. Well, most likely, and I'm not going to say for this fund, but most likely if a mutual fund is sold as a mutual fund, not an exchange traded fund, and they want to be on Fidelity's or Schwab or Vanguard or their competitors' platform, they give them part of this expense ratio. So now if this were happening, Uncle Schwab might be getting 0.05. So they might say, sure, put it on the platform, but you got to pay us part of the management fee. And then when your people want to buy it from us, buy a Fidelity fund from Schwab, then Schwab's being compensated. So then if it's a management fund that has a higher expense ratio, it's possible that the brokerage company is getting part of that management expense. Just be aware of that, because I know of some advisors, you look in their portfolio that they created for the client and they're all managed funds. And I'm going, oh, great. The home office is possibly putting you in high expense funds so they can give a little bit to the brokerage house so the client never sees the transaction expense. But why would we want to pay 0.45 if we don't think this fund is any better than the other one that's being 0.07? And I'm not going to tell you who that is. You're going to have to go find it because I don't want to get in trouble for selling funds here. So that's just some of the scuttlebutt. But let's say there might be reasons that this is a good fund, and let's see if they do anything for the 0.45. Quite honestly, very basically, I'm going to say in that mountain chart, if they beat the index, then it might be worth it. But if they don't, okay, they beat it a lot. Okay, so here's the balance fund index here. So 10 years ago, you put in 10,000, the index grew to 24, but this fund grew to 30. So now maybe they're arguing, yeah, you could go to out of the fund and pay 0.07, but if they only ended up here or somewhere a little bit higher than the index, don't you want to pay a little higher expense ratio and go for us? There's a million reasons why maybe that would be a good reason. I don't know. Maybe they do a better job managing the bonds. Now, on the balance funds, and this is why I've gotten out of many of them, they've made me concerned about, and this fund has a 13% standard deviation over the index of 10. It's a higher risk. So that's one reason that category goes up. On the downside, they don't drop 100% or the same as the index, they drop 110. So are you willing to take a little bit more risk? March of 2020, it was down 14% where the index was only down 12. So we see that there's a cost here, but if you just love profits and you don't care about the downside, not a problem. 25% is in the bonds. Maybe that other fund would have had a higher percentage, more stocks, but you might like that. You might say, I like this. I'm looking for the bonds, risk of the bonds, the duration of the bonds. They always get past me. The stocks, you'll recognize Microsoft, Apple, Amazon, Meta, Facebook, and there's that class A, and here's alphabet A and C. So that's why you have 105 stocks in the S&P 500, because some of them have a different category. And if you go back, the number of stocks are 352, and the bonds, there's 139. So again, this could be a fabulous fund you absolutely love, or there may be reasons that you don't like it. I'm going to try and find, and you can read into what the strategy is and how they do things. And if you like it, this could be a great balance fund for you. But if you're only in it for the cost, to get it down as far as possible, then you might want to look for an index balance fund. If this one's actively managed and they're doing things, then it might be a better buy for you. I was looking, oh, here it is. I'm going to look at the bonds. This is one reason. Oh, this is good. You'll read in the book something called duration, effective duration. Duration is the amount that the bonds in the portfolio will drop if interest rates went up 1 full percent. So if they brought Paul Volcker back, or his ghost, back in 79, 80, he had to raise interest rates 1 or 2% over the weekend. I mean, oh my gosh, bonds crashed big time. I saw 30-year treasuries drop 50% in value until interest rates came back down, and then they recovered if you sold them. The duration on this fund is only 4.97, which means if interest rates go up 1 full percent, the most that we would lose mathematically is about 5%. Now, we might lose more if people get scared, or less if it makes people confident if interest rates go up. The other balance fund I'm thinking of, the 0.07, its duration is like 7 something. So that's why I've been moving out of it. I don't like that. And this is actually not bad. If I was buying an actual bond fund as a cash reserve, then I would look at a duration of 0.58 or less than 1%, but I'm not going to earn anything. Or if I'm going to be in a short-term or intermediate-term bond fund that pays me 1.5%, I'm probably going to have a duration of 2 or 3. So the bottom line is, if you want something, there's always a price or risk that you're going to take, right? Squeeze a balloon, one side gets smaller, the other gets bigger. So if interest rates go up, the values can drop on bonds. And if interest rates go down, the interest or the value of the bonds can go up. I think we're all in agreement. Interest rates aren't going down anytime soon. So if I want a balance fund, they've only got 25% in stocks, and their duration or bond risk is lower than most balance funds. But you could say, you know what, to heck with this. I'm going to go buy an ultra short-term bond fund with 25% of my money, and I'm going to buy the S&P with the other 66 or whatever. That's fine. You could do that. I don't know if we'll see it, but in the trading activity, and it doesn't always tell us what this means, because part of this could be new money coming in, but they have a turnover of 37%. So if I'm paying 0.45, which is 10 times higher than, well, 8 times higher than the other balance fund, but I'm turning over 37% of the money. And if that turnover is causing me to make money, well, you make up your own mind. But this is what we go through in looking at some of these things. There's not very many balanced ETFs out there. This one is a fund. It's not an ETF. So that gives you some idea of some of the differences. Now, we've looked at a couple of these, Vanguard and Fidelity. Let's give Schwab a shot at it if I can get down. You'll see iShares, Invesco, and all that kind of stuff. Those are fine. iShares is the biggest exchange traded fund being issued out there. They're very political, however. They have ETF, environmentally, socially governance funds that they're buying more than others. So they don't like oil stocks. But one of the big rubs is, wait a minute, you don't like U.S. oil companies. You want to put them out of business, but now you're buying companies that deal in coal in China. So you'll see that in the headlines. I'm not making an opinion, but that's just what's out there. Okay, you'll see a bunch of funds here with Schwab. I wanted, before I go to the portfolio slide, let's see, Schwab. And sometimes they don't say total market, broad market. So now this is why, if you don't want to look this up, it drives me crazy because it's not Schwab US total market. They call it broad market. Okay. And I'm looking for total and I can't find it. The expense ratio, 0.03. So again, this is more of an index fund. They shouldn't have a lot of turnover other than bringing in new money and buying new things. They are going to somewhat ride with the index, a little bit less. Maybe their allocation is slightly less than the index, but their expense ratio is so low. So I'm not worried about this. It must be just a slightly different allocation than in the index. They're down 7.98. So notice The S&P was down 7.5. The broad market's down 7.98 because we have a broad market decline, but maybe some of the tech stocks are holding up better than the average broad market. So this could pose as a better buying opportunity if you think they're going to even out in the future, or maybe it's time to wait. But they won't be exactly the same because this one has quite a few more stocks. We'll take a look and see. Anybody's interested in sustainability, it's the biggest, I want to use the word racket, but there's a lot going on with funds that say we're 5 globes, meaning we're really environmentally sustainable and really clean and everything's perfect. But some of them that say they're 5 globes, you look them up and you find out they're not. So there's a big controversy with the SEC and regulating what people can say. It's kind of like saying buying foods that say all natural. We don't really know that that's true or what that means. So let's be careful with that. This is a Schwab broad market, slightly more volatile or the same as its category. Downside is 105%. They take a little bit more risk. I don't know that that adds up to being better. You saw them being slightly less. That I'll leave up to you. You can understand what these boxes are later. We mentioned value, blend, growth, and then small, medium, large. Don't worry about it. You have to stare at this stuff for hours before it starts to make sense. This little thing says how much is in style in growth. Is there a lot or a little, a lot or a little? So they're pretty much broad across the market. Growth versus high yield versus momentum, meaning very popular stocks, versus high quality versus volatility. So this is more of a, very broad equal balance versus a lot in momentum and a lot in growth like tech stocks or the S&P might be. So if you want to have just a little bit of everything across the board, this does look like it's offering that. You can look at these things later. I'm going to get down to the stocks. 2,557. And if you just want a holding of broad market averages, you too will have your biggest stock be Apple. And you too will have your biggest stock be Microsoft and Amazon and so on. But it has a large array of other small positions in small, medium, large stocks. So if you just want to buy something that represents everything and go into the time capsule and wake up in 10, 20, 50 years, this fund looks like it has a big representation. This just tells you how much money is going into the company recently. If you really want to get into details, and it's kind of fun, you can see all the way down here, how much attention are they getting? How much appeal do they have? Yes, this is important to me, only that I could get in or out and not have a big spread and probably be able to sell at whatever the shares are that are happening in the market. So those are a few fund examples. Now let's take a look at a portfolio. What is a portfolio? Well, it's going to hold a variety of funds, all from, hopefully, if you get nothing out of this book but diversify, diversify, diversify. You're not going to make as much money when you diversify because you're building a net of different positions. If I have a variety of funds and the S&P is down 20%, my guess is, because we're so well diversified, our hope is if they're all stocks, maybe we're only down 15 or 17. Now I could diversify out of all stock funds called equities and add in some bonds. Today it would be CDs, money market, ultra short term, and not get a return on it and lose to inflation, but at least it's stable. If I have half the money in fixed assets and half the money in equities, a balanced fund, let's say, and the S&P drops 20%, our hope is we might only be down 10. There's no guarantee. We'll teach you what beta means, standard deviation and Sharpe. And those are the indicators that we look at to create a portfolio so that in the future we have some idea of what the past has been like. So if we have a balanced portfolio with half of the statistical risk of the stock market, S&P, let's say, if it drops 10, we hope that we're only down 5. Now, again, if we're going to invest for the next 10 years because we're living off the portfolio, a nest egg approach is very important and guaranteed you're not going to make as much as the stock market. But if this is a portfolio for your grandkids that are 1 and 2 years old, and in 10 years you can reallocate to something more conservative for 3-4 years, so they can spend the money to go to college. If the net 10 years doesn't matter, if the 10 years don't matter, then we go to fewer growth funds and go for it. Maybe index funds if you don't want to gamble on strategies or managers. But this case, we're looking at a balanced portfolio, but this is a white-knuckled investor, a retirement person that needs to get some yield out of these funds. And also, when the market's down, doesn't want to be told, oops, I'm sorry, you lost everything you have. So I'm going to look at some basic things. With all these funds, Cohen and Steers, high expense ratio, high management, Fidelity, because they're well-known, Invesco, it's another well-known company, iShares, biggest ETF provider, T. Rowe Price, a little higher cost, but it's a fund that needs a manager, SPDR, Spider, State Street, so we have some representation of a different company, and of course, Vanguard. Rule number one is, in a brokerage account, diversify among as many different companies as you can for reasons I can't think of. Hacking, let's say. Then among those companies, in this case, we've got 18 different funds. If you have a lot of money, you might have 10 to 20 different funds to meet your needs. And each of those funds do something different. And if they do the same thing as each other, then get them at different companies, like a utility at State Street and a utility at Fidelity. Okay, we have a couple different representations. But try to diversify among companies, diversify among funds, and then internally, you'll automatically be diversified among tons of stocks, bonds, and cash positions. So let's take a look. I'm going to slide this over. It's going to be very small print, but I'll let you know what I'm seeing. Of all these funds, the yield on this portfolio is 2.74 cash distribution yield. The top fund here is 4.25. That's the Cohen and Steers low duration, meaning short-term preferred stocks and convertible bonds. The next one is Cohen and Steers preferred stock, all preferred stocks, pays 4.90. Now be careful though, preferred stocks don't have a maturity date. So they pay out a big dividend, but it's always that dividend unless they change it. So if you pay a high price and interest rates go up and people are going to rush over to buy CDs, they're going to sell your stocks to get out of there, because if I can get 4.9 from my preferred stocks versus 4.9 in a safe guaranteed CD, there may be a mass exodus if interest rates went up that high. Now, it would be nice to wait for interest rates to go up, buy the preferred stocks, but the preferred stocks don't have a maturity date. Bonds do. If I buy a 6-month bond and rates went up and I missed out, I can wait 6 months and I'll get my money back. If I buy a 1-year bond, 5-year bond, whatever, I wait it out or I sell it at a loss, but at least I get my money back. The beauty in the exchange traded mutual funds or mutual funds is I can reinvest my dividends and buy it at lower prices and ease my bruising. But in this case, if I just want the highest yield and I'm not worried about the share price, and maybe I buy from a company that instead of paying me 5.2, uses part of the income to buy downside derivatives to help me not lose as much if interest rates go up, maybe I do that. But don't just buy the yield. 2.19, let's see, I'm going to average these out so I can recategorize them. The highest one's at the top. iShares International Select Fund, 5.63, okay? Now, again, I'm not selling these funds and I don't encourage you to go buy them, but for the case of this discussion, the iShares International Select Dividend ETF, it's only got a 3-star rating, but it does have, that means historical performance, neutral, and Morningstar gives it a silver quantitative reading, computers decided. The last 12 months it's paid 5.63, but in the last month, relative to its share price, it's more like 5.40 going forward if you buy today. The yield is quite high because international stocks are known to sell for lower prices. Now, whatever index they're comparing this index to, this fund's far underperformed it. But if the index represents more stocks, yeah, large cap, large value. Now, why would this fund underperform it? Well, if they're looking for, look at the word dividend here, they're following this red index for the most part, but they're only going to take the stocks that have the biggest dividends. So the ones that give you more growth, they didn't buy them. They bought the ones with the big fat dividends. So over here, it would be like we only bought Verizon, AT&T, Procter and Gamble, and all these staunchy old value stocks that have big dividends, but we didn't buy the Amazons of the world and the other companies. So in this case, this company did less growth. Now, in the short term, they're dropping because they have more growth stocks in them, which are great long term. We can see that. But in the short term, look at us. We went straight up and they went straight down. Yay. Here we go. When the market's going down for growth stocks, or there's a fear of a recession and things don't look so good, value stocks tend to fall less or even go up compared to growth stocks. And so the overall international index is going to include more growth stocks, but ours, by the very name, and they don't tell us this in the name, we got to go do the homework. This fund is only looking for yield, so it's going to buy some yielding stocks. We'll take a look, and I'll bet they're probably not up and comers. They're just stocks that pay us a big yield. I wanted to look and see if there was a lot of turnover, and I didn't see that listed. You might have. Oh, and here we are, year to date. Our other total market index funds with the US is down 7.8 or something. And this is damn thing's up 5.26. So what happens when the market's not looking good, interest rates are going up and people are questioning the US value growth stocks, they start shopping around and they looked at, wait a minute, I can buy similar stocks internationally that are valued 25% because they haven't been so popular. So it's kind of like if you were to buy a free agent on a football team, the one that's done really great and made all these scoring, but has health issues, maybe I'll buy an unknown that gives me a lot more growth potential at a lower price. And that's what's happening now is people are buying internationally. If you watch Bloomberg or some of those other shows, they'll be talking about maybe it's time to increase your international allocation. Could be too late. Maybe it's gone up too much, but we'll see. Average volatility 21 versus 17 compared to others. So value stocks can be volatile. The weirdest thing happened in 2020 in March. These high dividend stocks actually dropped more than the high risk growth stocks. Why is that? The answer would be is we thought that the high dividend paying stocks that we thought would be the most boring, staunchy, stable stocks fell the most because if COVID caused people to be restricted, we couldn't get the earnings. They might have to drop their earnings from 5% down to 1%, and then the desirability would go down. People would sell the stock. So the low volatile ETFs, low volatile stock funds, drop more than some of the high volatile stock funds. Go figure. So as soon as you think you got it figured out, good luck. But we did hang in there and they bounced back. And the value stocks tend to do a little better than growth stocks when things are in question or dividends are desired and interest rates rise. But this is highly unusual to see them go straight up when interest rates are going up. But that's international. That's not the US. You'll see here all the different types of stocks, materials, consumer defensive, utilities. A lot of things are already established. British American tobacco, you may not like that. And or it's a high dividend stocks. These are more things that have held their value and aren't going to go down maybe quite as much. They've already been out there for a while, 99 stocks. So there were times where this particular fund didn't look so good, dropped maybe a little more than the overall index. So as soon as I think I know them, I find out I don't. But if in this particular portfolio, we're looking for big dividends, we're not as worried about getting as much upside. And in this case, luckily, they happen to go up a lot. So now I could say, well, I put you in there because I knew what was going to happen. No, nobody knows. It was a good, lucky allocation that we didn't want to have all our eggs in the S&P. So you'll see all these other funds that help this portfolio not drop as much. But you don't make money on diversifying. You avoid losing as much by diversifying. But if you want to gamble, obviously you gamble on one stock. I wouldn't recommend it. Invesco, another preferred stock fund, high dividends. It pays 4.8. Here's a high yield defensive fund that buys junk bonds, but does something to try to reduce the downside risk, and so on. T. Rowe Price, floating rate, junk bonds, short term, they're a good manager. Here's a utility fund. So this portfolio has an average of 2.74. The highest fund pays 5.63, but it could be down 20%. So don't just think the high dividend stocks are going to be safe. Down on the lower end, Schwab short-term treasuries. Here's a fund that if you wanted to park money and not earning anything, you could park it there. The expense ratio is 0.04, super low cost. And this is a weird phenomenon. Even though they're short-term treasuries, treasuries can drop in value if people think there's a better buy somewhere. So don't think that just because you've got short-term treasuries, they avoid a downturn. Now, they do and can go up in price per share if the stock market crashes and people are shocked and scared. But I would bet that this is going to come back because a lot of these short-term treasuries can mature and give you back your money. But year to date, they're down 1.48. A lot of bond funds, a 30-year treasury bond fund could be down 7. So go figure, short-term treasuries are down 1.5% because people sell them and it forces the price to go down. Now, if the portfolio manager holds them, they'll mature and you'll get all your money back. But if you wanted to cash out immediately, you could get beat up quite a bit. So those are all the different funds. So what do they represent as a total portfolio? This portfolio is pretty much on the conservative side. But this is a person that needs to start liquidating, maybe draw the dividends out. And if the market crashes, they don't want to be told they're down as much as the stock market. They have about 37% here in the orange in fixed assets like bonds and cash. I wouldn't be doing this today because the bond prices are overpriced. If I can get this other slide to move over. It will show us that after you've done all your homework for the individual funds and you have a list of exchange traded mutual funds, maybe a handful of managed mutual funds. Now, how do I put them together in the portfolio? This particular one has these percentages. You're used to seeing these in all your statements. 37, 38% bonds, a little bit of cash. This means the percentages among all of the funds in the portfolio. So it doesn't mean I have 3.9% in cash on the side. You can look at this stuff here that tells us a little bit more about value small, value mid-cap, value large. And there's a lot of value stocks here. Blend stocks and bonds, small, medium, large. Most of the positions are on the large companies because this investor can't risk it. Now think about it. Large company stocks, or let's say the S&P 500 versus the mid-cap size stocks versus the small cap stocks. Large stocks tend to have a historical volatility of about 17%, standard deviation, rolling average. No one year is the same, but average 17%. And they're only down like 7.5. That's far below the average. Mid-sized stocks have an average volatility, I'm guessing, at about 25%. So they could be down 25, 30, 40%. That's not unusual. Be prepared if you want to invest in mid-cap stocks, which is the sweet spot for long-term investing. They're not too small, not too big, but they are volatile, 25%. You got to be prepared for that. Now, small caps, I think they've been doing pretty well recently because there are not maybe as many tech stocks in there as my guess. Small caps do pretty well coming out of a recession. Maybe they don't fall as much when there's a big correction because they don't represent the biggest part of the market. But get this, their average volatility, from what I recall, is about 35%. So in an average bad year, you're down 17 with a large, you're down 25 for the mid, and you're down 35%, almost twice as much as a large cap. So there's always strings attached. No matter what you do, if you want to predict that you're going to get something better than your neighbor, it's already baked in. Bond prices have already fallen. So maybe when interest rates go up 1.5%, 2%, they might not go down anymore. Maybe it is time to buy. I don't know. Depends on the emotion and the calculation of the algorithm and the investors. So the best thing that I can do is create a portfolio that represents a little bit more of what the investors' emotions are. Now I can look at this chart and say, this is our portfolio in yellow. It is a today going backwards portfolio. No advisor can legally tell you this is where we're going in the future. Or if the stock market goes up 12, here's how much you'll make. I've seen that on insurance calculations, but in our business, we are fiduciaries. We cannot predict the future at all. We can say, the historical average has been this. If that repeats itself, sure. But I will look at what the average was. This is our portfolio. And the blue line is the average New York Stock Exchange, broad market stocks, not reinvesting. Okay. They did a little better than us, but we reinvested and we reallocated. So, and look at the downturn, we didn't drop as much. But is it worth it over 10 years to invest and get lower returns so you can have bragging rights one time? I don't know, but I know that most financial planners, there have been probably 4 downturns here that would have scared people a little bit. We're going to try to create a seatbelt and an airbag approach versus just go for all stocks. If it's a grandkids portfolio, there's no need for cash or bonds. Other than, yeah, there might be 10 or 20%. So when the market drops, if we're not going to add to this portfolio, we'll have some money. Okay, I buy that. I do that a lot. My aggressive investors, I try to talk them into at least 80% in equities, 20 in cash. So when the market tanks, we'll have some new money to use to move over there. Okay, so I want to know worst case, if you can see this, worst case scenario for this portfolio in the last 10 years. Unfortunately, 2008 and 9 is not calculated because it's farther than 10 years back. So be careful with the charts. They don't, unless they go back and include 20 or 30 years, you're not going to know. But in this case, all I care about is worst case scenario. This fund was down 11.4% in between January and April or so of 2020. But the stock market, the S&P dropped 38 and it averaged about a 20-25% decline. So given that we've given up growth potential by having part of the portfolio in bonds and cash, that's about right. Historically, we dropped about half as much. You growth investors, you're not impressed. You nest egg investors, that's a relief. This chart here goes left to right, up and down. As I go farther right, it gets more bouncy, more volatile. So we, the portfolio, are right about here with an average volatility of, I'm going to say 6% average. That's not a guarantee. The stock market during this period of time, the broad market was more a little over 12. So we're about half as much. But again, long-term investors, they don't care. I'll take all the risks in the world and get a higher return. But those of us living off of our 401k portfolio, that might be all you have plus Social Security. We can't risk it. We might want some of the funds to be money market, CDs, ultra short-term bond, short-term in stages of the next 5 or 10 year payouts so we can invest everything else in equity funds or stock-related funds. That depends on what allows you to sleep at night or keeps you up at night. The allocation in the portfolio should match what your fear factors are. Here's times that I think the portfolio did better than the index and then having all stocks than versus. So most of the time it underperforms a full stock market, but here it way outperformed it. Now we're down a little bit if the market's starting to recover, but that's understandable because we don't have all stocks. These are the numbers we want you to focus on. You can look them up in the book. Standard deviation, as I mentioned, is the average rolling average, okay? So if you go to the theme park with your grandkids and you promise to go on the roller coaster ride, and it's one that's got average ups and downs and then a loop and then a wild this and a wild that, the average might seem pretty easy. Kids come to you and say, look, the average volatility of this roller coaster is X. They cut out one little piece of the chart. They don't tell you there's a loop to do and all these other things. So standard deviation is a rolling average, but it doesn't mean that it won't drop any more than 18%, because as we've learned in 2008 and 9, it was down 65%. What the heck? Rolling averages aren't going to help you then. So this just gives you some insight and warm, fuzzy feelings, but it doesn't mean that it's a guarantee not to be hurt real bad. The average for this index, this benchmark, is the broad market. It was 13.42 volatility, meaning up or down, and our portfolio was only 6. But in those 4 times, let's say the market crashes, if we really want to feel safe, then we definitely need lower standard deviation. Something over here, beta, you'll learn in this class and reading the book, beta indicates how much risk to the overall portfolio is the overall portfolio to the overall market. So in this case, the overall market is the New York Stock Exchange broad market. So if it drops or it has a 1.0 risk, that means our portfolio is the same risk as the overall broad market or the S&P 500. If it drops, not the S&P, more specifically, New York Stock Exchange broad market, correction. So we are comparing ourselves to the broad market. If it drops 10 and we have a 1.0 same risk, then we drop 10. But in this case, we're only at 0.41 compared to 0.10. So we're only 0.41 or 41% as risky as the New York Stock Exchange broad market. It's not a guarantee that if they drop 10, we'll drop 4.1, but it's a historical average. So it gives me a somewhat of an idea that if I do this portfolio, it's possible that they drop 10, we drop 0.41 or 4.1. That's a good thing. Now, I would bet going forward, we would probably drop less if we're not using bonds that have some volatility, if we're just parking all our money in cash and CDs, losing to inflation, but less downside. So standard deviation is the average volatility of a roller coaster. It doesn't guarantee anything, but it does tell us that on average, our portfolio is half as historically volatile as the New York Stock Exchange. And then going forward, our beta for 3 years, 5 years, 10 years, and the 10 years is only 0.41. Given what the past has been, I'm just accepting the fact that we're 40% as volatile. It's not a guarantee, but it gives me some idea. Alpha here tells us that based on what we've done with this portfolio compared to other portfolios in the Morningstar universe, thousands and thousands of stocks and bonds, if they create average balanced portfolios with the same beta risk, 0.41, we've outperformed them by 2.96% per year over the last 10 years. Okay. So why is this important? Because if you just get an average balanced portfolio from somebody off the street or some company that you walk into, and they have half of them are their proprietary funds, high expense ratios. A lot of the funds are managed managed mutual funds where they pay the brokerage company a part of the fee. And so your average fee, instead of being 0.25 is 0.50, 0.6 or something. That's a high expense. So because our expense ratio is lower, I'll go down to it in a minute, and I forgot what it is for this one. But our risk is 0.41, and we've outperformed other portfolios with the same risk level of 2.96. That's what we want. We want a portfolio that has historically been more efficient, lower cost, better performing companies and funds. And you do that by screening the funds. We can never tell you what's going to be good in the future, but if we look at what's been great in the past, which companies have been good, it may help us out. Let me downside this. I want to get to the, okay, sorry for the scrolling, but as we get down here, we see the allocation. We talked about that. You'll see where the stocks are listed. A lot of these stocks are high yield. A young person doesn't want that. Classic growth and all that type of things. I'm going to try to get to what we're looking at here. For the bonds in the portfolio, our average credit ratings are 50% in AAAs and triple Bs, 14, and so on. We do have some double B and single B because nowadays it's hard to find AA bonds that pay 3.5%. Where are you going to get it? So unfortunately, and this is why we need more bond managers in a managed bond ETF, because if I've got money all the way down here in single Bs, the economy crashes. Those companies are a thought not to be able to pay back their bonds and maybe at risk. I want my bond manager to try to get us out of those before everybody else realizes that. So my bond funds, I'll use more managed bond funds if the credit rating of the bonds are triple B or below. If they're maybe triple B and triple A's, I could buy a bond index fund like the Total Bond Market Index Fund, although they do have too many long-term bonds in there. So I'll buy another short-term bond index fund that's good credit rating. I don't care. I don't need a manager. And if they're short-term bonds, I'm not worried about interest rates going up and I'm not worried about their credit rating. But if I'm going to go down here to triple B and below and dip my beak into the high yield area and get some really cool returns, I want somebody to get me out of some of those junk bonds that might be with a company that could be running into problems. And they're going to know that before you and I do. And by the way, there is no bond market exchange like there is a stock market exchange. You can't sell individual bonds in an exchange. You've got to get on the phone and call Uncle Charles or somebody else and have them find a buyer of your bonds, which could cause a lot of time and discounting. So one, it's safer, in my opinion, to buy the ETF if you're buying low credit rated junk bonds, but I would prefer to have that ETF or mutual fund have a manager because they live and breathe this stuff. I wouldn't know which company's running into debt problems or cash flow problems. I want them to get me in and out. So index funds, high quality, managed funds, low quality. Fund or ETF, that's fine. This particular portfolio has a duration of 2.87. That's not bad. Anything below 3. Now, it has caused us a little heartburn in the last month and a half. We're probably down on some of these bonds. I would say 0.5 to 0.75%, maybe 1%. That's good. Some of the ultra short terms, we have nothing down, but we just saw a short-term treasury fund drop 1.5%. So the duration on the bonds in this portfolio are only 2.87. Now, a duration of a 30-year treasury bond, guess what that is? That duration is 17. What does that mean? If Paul Volcker comes back and raises interest rates 1% over the weekend, our bonds statistically should drop 2.87%. Nobody likes that, but it's a lot better than the treasuries dropping 17% overnight if you resell it and you don't wait the 30 years. Okay, last bit of information before I let you go. Expense ratio, the expense ratio, the net is 0.27, but the expense ratio is listed at 0.29. 0.29 is what the funds will charge on average. We have one fund that charges 0.02, another one 0.80. Yes, I wish there were cheaper ones, but they haven't come out yet. But our average expense ratio is 0.29. But wait, there's more. The net expense ratio is less than that, 0.27. What happened there? Some of the ETFs might have been lending out our Apple shares to other people, making some rent money and giving it back to our fund, thus reducing the actual cost. So there may be a couple ETFs out there that had 0.35 but really charged 0.25 because they were able to make money, but for the fund. So I've rushed over quite a few things here. I apologize for you people that I moved too fast, but it's not really possible to get through as much as we do here without doing so. But the book, you can order a free copy from us. We'll pay the shipping and everything. We're not making any money off it, but the book was written for this class. It is the workbook for active retirement investing. And if you're like me, I need to highlight and write, you can get a copy of it. That's not a problem. Or you go to the website and you can download it, or Marcia can send you the link and do that. And apparently there's apps out there that you can download the book and then somebody will read it to you. So that's cheating, but it's available to you. So next week, Paul, we're going to start, I think we're in lesson 3. we're going to start on page 104 and go to page 128. 104, 128, and you'll see in those little charts in the little box at the upper right-hand corner what page we're looking at. If this is new to you, don't be discouraged. Why would you care what beta means? It's like if I were to ask to rebuild an engine, I wouldn't have the slightest idea nor the interest. If you have the interest, read this book very carefully, detailed, and go step by step. It will tell you the financial planning process, the fund selection and replacement process, the portfolio construction process. And then you're not done. It tells you how to maintain and what to do for maintaining your financial and estate planning checklist, and then what to do for the portfolio on a daily, weekly, monthly, quarterly, biannual, and annual basis. I've added all this stuff because you guys used to ask me, does this go to another level? Yeah, I took some time and wrote a book for you. It does. And you can go to the back of the book and see what you need to do all those times. But more importantly, if somebody else is doing it for you, you'll know what they should be doing for you. So with that said, thank you for attending. And I will try to come out of this program. And if I do it right, there's the real guy. See you next time on page 104. Take care.
Bill?
Yes.
Will we be able to access the recordings at all for review, or if we have to miss a session or anything?
We're hopefully, yes, we're recording the programs. What we have to do is upload it to my editor who will edit it. Then they have to upload it to legal. And then when they give us approval, we'll be able to put it on the site. So it won't be timely immediately, but our hope is to get all 6 classes onto the website for sure.
Great. Thank you.
Great. Any other questions? This is your time to ask free questions. No cost.
Thank you.
Okay, see you next week. Take care.
Thank you.
Take care.